In this video, we're going to go over Liquidity IQ, which is our adaptive multi-timeframe technical analysis indicator. This tool gives you important support and resistance liquidity zones from multiple higher timeframes, and it signals important events like liquidity captures and zone breaks. It's available for multiple platforms like TradingView, NinjaTrader, MotiveWave, and MetaTrader. So markets don't move in straight lines. They don't go up and down in predictable ways. To a great extent, the movement in any market or any instrument, any chart time frame is largely unpredictable. There's a lot of noise and a lot of chop, as it's called, where price action kind of jumps up and down in ways that oftentimes aren't so easy to foresee. I tried to grab a little snapshot here on the right of a chart that might be reminiscent of such a scenario where you have these giant candles and then, greatly varying levels of volatility and movement that aren't so easy to foresee, especially when you're day trading and you're trying to make short-term trades. I'm sure all of you have experience with this if you've done any type of day trading where you enter a trade, maybe you're on the 1 minute or the 5, 15 minutes, and you set your risk and reward or your profit target and stop loss. And then something happens that's just so unbelievably insane relative to what you expected, where a price makes a massive move and you didn't foresee that. And maybe it crosses through your stop loss, or it goes to a zone that you didn't expect it to way quicker than you expected it to in the worst case scenario even. And we wonder, why is price so erratic? And if there is so much crazy action on the average chart, then what are the focal points that we can focus on to give us a more stable outlook whenever we enter a trade, so we can more realistically place our entries, our exits, or our targets, and our stops? So whenever we're trading, whenever you look at a chart, for example, if you wanted to trade NASDAQ futures right now, you're basically always answering some form of the same questions. So you want to make a trade. And number one, you're going to ask, well, where do I expect price to go? Because if you have no expectation of where price is going to go, why are you making a trade in the first place? You would just be gambling. If you're buying a stock, you're going long, or you're buying an instrument, you're of course expecting it to generally go up, and vice versa if you're going short. So you always are going to be asking yourself, where do I expect, or where should I expect price to go? And the second question is then, how can I make a smart trade based on this? So I might see a Tesla stock, let's say it's at $170, and I think it's going to go up to $200. Or I think it's going to retest resistance at $200. So I know, where do I expect price to go? $200. But then how can I make a smart trade based on that? So maybe, it's not a great time to enter right now, or maybe there might be a retracement. So even though I expect eventually it'll go to a certain place, I still need to figure out, how can I plan out my entry and my exit, my target and my stop to make this a smart bet with a high probability of success? And this plays into the next question we all ask, is where can I look to manage my risk? And I say, where can I look? Because if you have any experience trading or day trading, oftentimes you might tell yourself, okay, I have a profit target of 2% and a stop loss, let's say, of 1%. Just because your stop loss is 1% doesn't mean that placing your stop 1% away from your entry on the chart is actually going to be a wise decision, because perhaps the symbol you're trading has an intraday volatility of 10%. Maybe it fluctuates up and down 10% in the course of 2 hours. So having a 1% stop loss in that case isn't always wise. And it's usually better to find, based on the chart you're trading, what a logical place to base your risk is. And then instead of hard stamping or having this static risk reward mindset, you instead adjust your sizing and your positioning based on where it makes sense to place a stop loss or a target according to that chart. And playing into that, the answer to those questions most of the time is just, you need to know where to look. And we believe that there are powerful price levels on every instrument, every chart, and they act like attractors or magnets for both the price action and the eyes of all traders. So if a stock like Tesla we're talking about there is moving between 150 and 200, and maybe 200 is a historical resistance level, that is one of those powerful levels, most likely, because it draws price towards it like a magnet. It's the big 00 number, 200. The eyes of all traders are on it. Maybe in news releases or press releases or opinion pieces, they're talking about the 200 level because it's such a major zone. And price tends to be drawn to these areas, if just for a short amount of time. And when it does hit those areas, there's often repeating patterns of behavior for how it reacts to these zones. And these zones are areas where major players, and they don't have to be just these psychological levels like 200, they can be arbitrary price levels, as we'll see in a second. But these areas and zones that we want to pay attention, where you need to know where to look, are the areas where major players and institutions often place the majority of their trade entries and exits. And you'll find that these areas are where an exceptional amount of trading volume occurs. And they're known commonly as liquidity zones. So these are areas where once price visits this zone, it often reaches, price action reaches an extreme in either supply and demand. So when there's an extreme in supply, price goes down. So this often is characteristic of a resistance zone. If price goes up to, let's say, $200, like on Tesla, and there's a high amount of trading volume, and then price fails to break 200 and it drops back down to, let's say, 180, that 200 level is a liquidity zone where a large amount of usually big players with large amounts of capital or large amounts of shares caused an excess of supply into the market. There was a lot of shares exchanging hands, and ultimately supply won out over demand. So the event that happened when price reaches that $200 level is a pattern that you can notice if it's a repeating pattern. So if price, whenever it visits that level, supply always exceeds demand and we drop back down, that's a repeating pattern of behavior that you want to know about, and you want to keep your eye on that level and perhaps base your trades on what you expect to happen when price visits that point, or just base your trade based on the expectation that price will go to such an area as it has in the past. So you can't predict where price will go, but the idea behind this approach of knowing where to look is that you can't really predict much at all with price action in the short term. There's a lot of noise and volatility up and down and choppy action, but you want to keep your eye at least on these zones that seem to draw price towards them consistently. So you can make bets based on the idea that price will return to them and perhaps react in a way in your favor. And you do this by noticing patterns. And we've created a tool we call Liquidity IQ. And this tool is still in the works. And you're going to see we're trying to develop and get feedback as we create it. And I'm going to show you it in TradingView. And the idea with this indicator, Liquidity IQ, is that it hones your focus on the chart, helps you spot these opportunities we're talking about. It'll facilitate your decisions and risk management, and it helps you track these major liquidity zones and events. And this indicator is supposed to basically take the technical analysis process away from you so that you don't have to worry about that. When you open it up on the chart, you see the important price levels. You see the way that price reacts to these levels very easily. You can see the exchange of high amounts of volume. So where liquidity where there's excessive liquidity, so spotting these important liquidity zones where hopefully, or where usually, big players are placing their bets, and also giving you really easy guiding rails when you apply the indicator to the chart. So at any moment you apply this to any chart, you can very quickly come up with a hypothesis for where you think price is going to go, and have an idea of where you might be able to place an entry or an exit, a target, or a stop. And this indicator is really based all around this concept of liquidity zones. So let me open up TradingView now. I'm going to go through the indicator's features one at a time, and I'm going to build it up slowly because there's a lot of stacking levels to this where one thing sort of builds upon the next. And this indicator looks at, depending on the chart time frame you're on, like I'm on the 30-minute here, it looks at multiple higher time frames automatically depending on the chart you're on. So I'm on the 30-minute, it might be looking at the 1 hour, the 4 hour, the daily, and the weekly chart. And if I go to the 1-minute chart, it's not going to look at that high time frame. If I go on the 1 minute, maybe it'll look at the 5-minute, 15, 30, and hourly. And it does this to find out what are the actual significant support and resistance levels from higher time frames. And it'll then plot them on the chart. So this is the base logic of this indicator. And I'm going to go one step at a time. So right here on this chart, you see these blue lines and these pink lines. And these are customizable color themes. So it's not always going to be blue and pink. But the lines on top are essentially resistance levels, and the lines on bottom are support levels. These lines are not only based on historical highs and lows from higher time frames, so these confirmed significant resistance and support levels, but they're also only taken into account or added into the structure shown here. And we call this the liquidity structure, support and resistance liquidity structure. They are also levels that are weighted by volume. So when we spoke about liquidity, we're talking about the amount of shares or the amount of trading happening at a certain level. Not only are these high quality dynamic resistance and support levels, but they're resistance and support levels that coincided with abnormally high trading volume. And this is kind of the feature number one of this indicator and the base feature. And you can see over here, we have these little zones here. And these zones are always going to be at the end of the chart. So whenever you apply this to the chart, you're going to see this zone. And we actually see one of the phenomena that we're going to talk about really shortly happening in real time right now. So this area right here is called a support zone, liquidity support zone, and this is a liquidity resistance zone. And these zones change in size depending on the current volatility of price, because oftentimes a mistake traders will make, let's say if we look back here at this high. So let's say a trader goes short right here and they set their stop loss right up there at that high. Well, it's not always wise to set a hard stop loss right at that level, because as I'm sure you've noticed, price doesn't always just retest old levels and treat them like magic lines in the sand. There's usually going to be a little bit of leeway where maybe this does act as resistance in the future, but price might go, let's say, $1.20 above it before coming back down. And a good example of that is, let's say, right here. So let's say this level right here is support, or you're considering this support, and you are hoping on a long trade that price isn't going to lose that support. Well, look what happened here. In this little volatile region, price came down, broke beneath the support, but it didn't really lose it. It's still at the 15,800 range. So this is 15. If you were considering this level here, like 15,827 as the ultimate support, you would have been stopped out of your long trade because price, had some leeway to go down and test 15,800 or even 15,799. So all the guys or all the traders who would put their stop loss at 15,800 here, they would have lost out, and price would have only gone down to 15,798 or something before going back up in their preferred direction. So we have these areas that we call these liquidity zones right when you apply the indicator to the chart. And what these highlighted zones are always going to be demonstrating to you the nearest resistance and support liquidity zones. And the reason for this is when you apply an indicator to a chart, when you open up a chart with no indicator, it's not so easy to tell what's the important positions right here, is it? If I look at this chart, I might be thinking, okay, maybe there's support down here in this region, but where the heck is the resistance? Is it up here? Well, we broke through that up here. Is it here? Is it here? It's oftentimes difficult, especially when you're on smaller time frames. Like if I go to the 5-minute, it's kind of even harder to tell where the heck are the lines in the sand. Where are the important zones here? And that's the idea behind this first aspect of Liquidity IQ, is that it identifies volume significant support and resistance zones and highlights them on the chart for you. And these are dynamically selected from higher time frames. And we see one of the phenomena we're going to be talking about very shortly right here. So look at this nice, so price broke through this old resistance level before it rounded out, and we had this little downtrend here back through 16,000 on NQ. But look at how price comes straight down, no stopping it, just a straight roller coaster or a ramp right down. And then look where it finally rebounds and finds some support. It finds some support in this zone, this resistance liquidity zone. This is one of those important levels that this indicator is all about identifying. These are the levels that are kind of the zones in the sand between all the noise of intraday or intra-market action. So we get in markets often visitations or runs or trends to these important zones, and then there's a bunch of chop or flat action in the middle before we finally revisit one of these zones again, or a new one is developed. So this zone right here, let me come back to, let's say here, and I'll wait for the indicator to load. And Daniel, in the meantime, are there any questions I can answer? Should I go?
Actually, we
continue?
do. Yeah. Wayne is wondering, that's actually a really pertinent question. Do these zone repaint, and when does it happen?
No, they do not repaint. So in Trading View, there is a thing called bar merge look back when you're programming your indicators. And if you set it to this one of the settings, the indicator will repaint, because the only way that this indicator could repaint is because it's looking at higher time frame data. If you program on Trading View, you'll know about this. But we basically follow the guidelines from Trading View and to prevent any repainting from happening. It doesn't happen. And when we publish this indicator, Trading View will actually take down your publication if it does repaint and you try to make it one of these invite only scripts. So you can be guaranteed that these levels do not repaint. So the reason why I went back in replay mode here is because I wanted to show that when price was rounding out here, look at this zone that was being highlighted down here, this liquidity zone between 944, 932. So already back here, when you apply this indicator to the chart, your eyes are drawn, or at least mine are. And of course, we can continue trending upwards into uncharted territory where there is no previous resistance or support. We would have to wait for price action to develop some sort of new structure that we can base our ideas on. But at this point in time, if there is some sort of rounding of the trend, our eyes are down here at this nearest liquidity zone. This is the most recent spot where big money or some significant amount of volume entered or exited positions. And generally, you can expect, the concept of retracing or filling gaps, although there's no gaps here. You can generally expect, except for, in exceptional circumstances, that at some point, this zone is going to be revisited. And that's exactly what happened if we go back to current price action. So we were looking at that in replay mode up here. We were being told that we might have a visit back to the 930s. And look what happened. From there, all the way down to here, and this is, the live market, look exactly where it stopped. It stopped right there at 15,930, with some leeway to the 15,920s, 940s. And we bounced because this is an area that's being defended right now. Some significant amount of volume or trades, positions are based off of having their entry, their exit, their stop loss, whatever, in this zone. And this is where units are exchanging hands between traders or players in the market. It's a liquidity zone. And as data moves forward, as more bars roll in and time goes on, this indicator will continue to identify these new volume significant resistance and support zones. So we can see right up here, and it's looking at higher time frames. So it takes a while for the indicator to actually confirm that even on a higher time frame, that's a significant level, which is a good thing. And we can see right up here, starting in the last 30 minutes, the indicator says that, hey, up here at 16,119, this region, there is now a new zone or resistance level forming. And we don't see this zone around it like this because currently that's not the nearest zone. So we are highlighting and putting these volatility boxes, these range boxes around the nearest liquidity zones to draw your eyes to the most probable area that price will visit. And if we get maybe to this point right here between these two zones, this one will become the red and the top one will become the green. So this indicator at this level, so this is base, feature number one, it's all about immediately giving you high quality technical analysis and an idea of zones that price will visit so that you can straight away, when you apply it to the chart, at least get a concept of where price has been, where it might go, and what you might be able to expect in terms of movement for the day or, the short term. And just to highlight again, we turn this off. It's not so obvious where these areas are. It's really a big hand. And at any time back historically, if we're looking at the chart back here, we would also see those zones according to price as they were at the time. And you can see, and just on that repainting point, whenever you're looking historically, so this is something important to note, whenever you see one of these lines, like right here, whenever that line begins, that's when you would have seen it beginning to plot at that point in time. So if you're looking historically at these lines, that's how it would have been in real time. So oftentimes this can be surprising how significant these areas really are, because for example, here we have these two highs, and then this was identified as a volume significant resistance level. And then you can see, you can imagine at the time that there was one of these range boxes around it. And just look how price came into that range, came back into that range before finally breaking through it. And similarly down here, the support, you can see price rebounds, and there's play or trading off of these zones. There's more chop and volatility and noise in between these zones than there is when price hits them. So we've spoken vaguely about now price visiting these ranges. And these zones, we call them liquidity zones, and that's kind of what they're known as commonly. Liquidity zones, where there's a lot of volume around a significant price level. But we also have, and we call this structure, so market structure, you can call it support and resistance structure, liquidity structure. And we have liquidity levels on right now. So that's the feature we had right there. But with liquidity, we also have another feature called liquidity captures. And what we consider liquidity captures, so we've kind of defined these events, is a liquidity capture is when price comes into one of these areas and there is a significant exchange of volume. So let me turn those on so we can highlight the liquidity captures happening on the chart, and we can draw some conclusions about them. You're going to see these little highlighted boxes in just a moment.
And Nicholas, real quick, while this is loading, we did have a few other questions. Let me just take one of them. Robbie wants to know, does this only work on time-based charts, or are other chart types supported too?
I don't think we've even tested it on other chart types. I believe that it's going to primarily work on time-based charts because the dynamic identification of support and resistance zones is based on higher time frames relative to the chart. So something like a range chart, it's not going to be working as intended, as we intended to on these time-based charts. Okay, so although we haven't tested it at all on these other chart types, I'd be biased towards it being best to use it on time-based charts.
Thanks.
Okay, so just take a moment here for this to load. And this indicator, by the way, Daniel will be speaking about our future features that we're still working on for it. So it's still in the works. So here we go. So now I've applied some, I'm going to zoom back here so we don't get overwhelmed. So we spoke about price visiting these different levels, like these resistance and support levels. And you might be able to see now these little boxes all on the chart. So for example, right here, we can see these little red boxes, and here there's these green boxes. Here there are these green boxes, red boxes, etc. And these boxes are what we call liquidity captures. We can see that when we put our mouse on top of them. And what a liquidity capture is a liquidity capture represents a moment in time when price wicks, so the high or the low of the bar, enters into the range around a liquidity level, So it enters into a liquidity zone, and there's an exceptional, so something like 3 or 4 times the average volume occurring on that bar as price enters into that zone without breaking through it. And I want you to draw your attention to something about these events. Notice that whenever we get one of these boxes or a cluster of these boxes, price tends to be rebounding off of those levels. We can see that happening right here as well. Price came down, there was high volatility, so the range around this level was large. There's a big zone of liquidity here. We got liquidity captures, which we would have known about right at this moment. Right at this moment, we would have had an alert that there's a liquidity capture at this support liquidity zone. And what that's telling us is price plummeted into this support area. There was a massive exchange of volume, so big trading volume, and it didn't break. So the support zone did not crack. We didn't lose the support zone. In fact, the trading volume got absorbed. So this can be interpreted in several ways, but the common interpretation of a liquidity capture happening in an event like this is that somebody's buying up all of these sells that retail traders probably are selling into this level. They're expecting that we're going to go lower. Meanwhile, the big players are jumping in with big money and actually buying it all up. We get 3 consecutive liquidity captures here before, boom, we rocket up, from 14,600 to 15,160. Similarly here, we have the inverse effect. It looks to the average trader that we're going to break this resistance zone. In reality, people are buying, expecting a breakout, but there's actually more supply than there is demand, and that's a liquidity capture. They sold into, in this scenario, the foolish thinking of the short-term trader who's trying to play this upwards, and they sold it, it rebounded, and this liquidity capture again was a nice rebound signal. Now, there's different scenarios as well, and this is what we're talking about, pattern behavior. Patterns of behavior. So right here, we have a single liquidity capture. And even here, when price came down to this level and touched it, look, that one liquidity capture was a signal that we're actually going to be rebounding off of it. And that's exactly what happened. It rebounded, from 820 to 920 or 950 in a short period of time. But one thing about these liquidity captures we mentioned, and this is why they're such powerful things to note, is they only occur when the level's not broken. So if price breaks through the level and there's high volume, like right here, there's high volume, right? People are buying, expecting this breakout past this old resistance. But price doesn't break the level. So traders are actually kind of getting tricked in this scenario. They're buying, but there's no breakout. And their liquidity, the liquidity they're providing by buying, is being captured by bigger players who are just selling at a profit to them. But back here, for example, when we broke through this level, look, there's no liquidity capture because price broke through the level. And in this scenario, we had a little bit of a confirmed break here because there was no sign that somebody's putting the brakes on price action or putting up a wall of orders, a big block order, stopping price from moving through that level. So this is why it's really significant to note that these liquidity captures are significant events, because they note that not only is there super high volume that's really uncharacteristic, but the level's not being broken. The range of that level is not being broken. And to the naked eye, that's not so obvious. Like, where was that level even? Looking at this chart, where did it even come from? It's not obvious. So when you have these stacking concepts, where first of all, we're building on this structure, now we're building on this concept of exchange volume or significant volume, you're really able to see these patterns and predict or expect, have a better, higher probability of being able to expect correctly what might happen, because you can see kind of the invisible matrix behind the price action, and what's happening. The average guy looking here doesn't really know what's happening. He might have an eye on this previous resistance, but it's not so clear. He doesn't have an indicator that's doing all of this for him. So those are one of the types of markers we have on the chart called liquidity captures. But we also have another type of marker on the chart. And I want to draw attention to that this indicator is supposed to be like a mentor or a guide, or like a master of technical analysis that's giving you all these ideas and drawing your eyes to important things on the chart. But it's not giving you buy and sell signals. It's not saying do this, do that. So when we look at this signal here, This signal right here is not a sell signal, but it's just like a liquidity capture signal. By the way, well, I'll get to that in a second. I just really like these captures we have here as well. But this signal right here, and we'll see ones to the upside as well, those are breaks. So confirmed breaks, we call them. And they happen when, for a sell break or a downward break, sorry, like this, they occur when price not only plummets through a support liquidity zone without being stopped by high volume like a liquidity capture, but on the next bar, it's fallen so far through that zone so quickly that the high of the next bar is actually even below the range. So not only did it have no trouble breaking through that range, that zone, but it's long gone now. It's past, like the zone is now in the rear view mirror because price is going past it quickly. And we had this little break signal here, and look what happened. We got a significant downtrend after that. So there was no liquidity capture. The level was lost. And we had this nice little downtrend. And look at this right here. This liquidity capture. It's exactly what we just spoke about. Price came up to a resistance zone. There's high volume. We get a liquidity capture, and look, perfect reversal off of that. Same thing here. This one's actually really nice because it has, these two giant candles side by side, followed by that. And here, look, another liquidity capture down here. Nice reversal. This was back when it was in a range. And these liquidity captures, like you can see that it's not right at the line. They only occur, liquidity captures only occur when price is within a range, this range at the moment, at that moment in time around the zone. And this is happening right now. You can see we've got these annotated labels here. We were just talking about this where price, we could have expected that price would come back down to this zone. And look what happened. It came down right on this bar. You would have had that signal, liquidity capture near 15,940. There's that marker. And it's telling us there's liquidity capture near that level. And look, rebound right away. And now we've got this further explanatory annotations on the chart. And I'll get into this in a bit, but this is telling us, hey, in this zone here, this liquidity zone, there's been one capture. And oftentimes you'll see when in this one, there's zero captures. And it gives you the range here, between 15,928, 15,952. So if you were looking to buy in on this, expecting to rebound off of here, you might be waiting for it to get down to the lower end of that range at that moment in time. Once the capture comes in, you buy, and you set your stop loss somewhere relative to the other zone or, your risk. But these captures, so you're going to notice these repeating phenomenon behavior. And this is why we found it so interesting. The reason why we put the number of captures here is because we found that when there is a large amount of captures at the same zone, so let's say this keeps happening 5, 10 times. So at that point, there's 5, 10 times the amount of exchanges or high liquidity moments at that zone. Well, we don't know what that means. Does that mean price is going to break it or price is going to rebound off of that zone? We don't know. But what we do know is there's an extremely significant amount of action happening at this zone, and something big is about to happen because somebody, some institution or group of institutions or major players are loading up either to the short or long side in this area. And it's not just insignificant flat action. So when you get a bunch of consecutive captures around the same area, and then all of a sudden price rebounds upwards, well, you might be about to see a big trend upwards. And similarly here, we have one of those breaks. So we have an annotation, and the annotations, this is an option, but we're only showing them for the most recent ones because, of course, if you had one of those annotations for every single capture, the chart would get cluttered very quickly. But right here, we can see.
Just real quick, guys. Sorry, Nicholas. This is what we call the mentor mode. So the indicator, if these annotations are enabled, the indicator will tell you exactly what you can see for the most recent price action on the chart and what these zones and labels mean.
Yeah, exactly. And so, yeah, when I look at this chart right away, the first thing I'm being told is we've got a zone down here as support, a zone here as resistance. And I know that we just rebounded off of this area. Perhaps this is a good time to actually start to enter into a short position, expecting for a short-term gain for us to revisit this area. Or perhaps, it's a good idea for us to have caught this long back here, or perhaps wait for a new capture down there once we return back to that area. but of course it's discretionary. But I want to draw your attention. So here, this is that zone break event we were talking about. So there's liquidity captures and zone breaks. And this happens when price has no problem thrusting through a zone. And that's what happened right here. Price broke through this resistance zone. There was no significant block orders preventing it. And we got a zone break signal, which would then followed by a nice little momentous move upwards. So, and right back here, we can see this was the most recent liquidity capture around a support level, which ended up as well being a great buying opportunity as there was significant volume as price showed support down at this zone. And look, it was followed by a breakout attempt right here. And here we can see a liquidity capture followed by a break. Oftentimes, liquidity captures don't mean reversals 100%. They can, all they're telling you is that there's significant volume as price visits this zone. Okay, now without further ado, I'm going to move on to the next aspects of the indicator. And Daniel, are there any questions I can answer?
Yeah, there are a couple of questions, but I think you're going to keep them to the end because I also want to soon get you to let everybody know how they can get this indicator. So Nicholas, maybe quickly cover the next feature, and then
Sure.
I will take it back and allow you guys to know how you can get hold of this indicator.
Sure. So the next feature, and we've got, like Daniel said, we have mentor mode on here, which is giving us these labels. And the idea with this indicator is that you apply it to the chart, you know what's important, it does the technical analysis for you, and you really easily get trade ideas and places ideas for where to set your targets, stops, and where to wait for an entry. So if I look at this chart, immediately you look at the zones that are highlighted for you. And let me go over to another time frame. So let's go over to the 1 hour. You can also set kind of the time frame for your trades. So let's say I'm on the 15-minute chart. Okay, well, I'm going to be shown now these support and resistance liquidity zones based on the 15-minute chart. But so right here, I'm being shown, hey, there's a zone up here, this resistance zone. We just rebounded off of this area, and there's a support zone down here. But this is because I have my reference time frame set to chart. I can actually be on the 15-minute chart and say, actually, I want to know about the price action and liquidity structure happening if I was on the 2-hour chart. So just because you're on the 15-minute chart doesn't mean the indicator has to be on the 15-minute chart. You can be on the 5-minute chart and set the indicator time frame to the 1 hour. So although you're on the 5-minute, you're making your decisions based on the 5-minute candles, you're actually getting a much longer term, bird's eye view of the market because you're looking at a higher time frame. So right now at this moment, I'm on the 15-minute, but I've got the indicator applied on the 2-hour chart. And you can see now we've got this much wider range because, of course, on the 2-hour chart, the levels and the support and resistance zones are much further apart. So I don't want to take too long on that feature. Let me move forward, but it's extremely handy. And if you've used our MTF Fusion indicators, you can imagine how useful this is. So the next thing that we are going to apply to the chart here is our trend momentum analysis. So we looked at structure display, which was support and resistance or liquidity zone structure. But we also have analysis for momentum, and there's a lot of different options. I'm just going to use the default ones here. So we have different methods based on super trend and moving averages. But this is also, and you'll see with mentor mode, once we have the indicator complete and released across all platforms there, that these are also going to help you with your risk management and determining what the most likely next event is. So these 3 lines you see here now on this chart, which change colors like here and back here, these are basically trend lines. To some extent, they're a little bit more complicated, and they're based on 3 higher time frames, these 3 lines, and they're actually based on something like 12 higher time frames. They're combinations of time frames, and they're meant to really give you a good sense of what the overall momentum is at a time frame higher than your current chart. So you don't have tunnel vision to, like, let's say you're trading the 5-minute. guess what? The 20 moving average on the 5 minute isn't that important. So if you're basing all of your risk management off of a moving average, like a 15 moving average on your 1 minute or your 5 minute chart, it's not always wise because it's not such a bird's eye view of what's happening. And you can see that these moving averages tend to ignore a lot of the noise. Like right here, we went green basically. And although we had some dips back into the trend, these held this upward momentum. And look, they coincided with these consistent zone breaks right here. Boom, 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 as we moved up and up and up. And finally, when we went red, only then did we have a break downwards and then a liquidity capture right there before price rebounded and things went green again with the momentum trend analysis. We got more breaks, and look at these breaks. It's actually a very nice chart by chance here on NQ. So we have the SR structure, the liquidity zones, and that's great. It shows you these zones, but we also then have the trend and momentum analysis that's supposed to help you figure out, okay, well, where do I think price is going to visit next? So looking at this chart, for example, right here, we're just starting to go red in the momentum and trend analysis. Maybe if we can get red on the last trend line down here, it's probably going to be more probable that we visit this support zone than it is we visit the resistance zone first. So we might want to enter a trade with the expectation, like we mentioned before. Question number one is, where do I expect the price action to go? And that's what this indicator is supposed to help you figure out first and foremost. Where do I expect things will go? Me looking at this right now, if we get a little bit more downward action, I'm expecting we're at least visiting here first before we're visiting up there. But of course, we see as the market develops.